It's times like these wherein we really appreciate large money managers joining in. We were speaking to Sanjay Parekh. Absolute delight to get in Sunil Singhania, founder of Abacus Asset Managers. And Sunil, thank you, really thank you for joining in today, because such an important day, because after a long time, there seems to be panic coming in from a lot of quarters when people are messaging me as well about this. How are you thinking about the current landscape, Sunil?
Good morning, Neeraj, and good morning to all your viewers. So I think markets have been challenging. There's absolutely no doubt about it. And as you rightly said, particularly the last 3-4 days have been, very scary when you see the screen. The Nifty is not indicating the full thing. The Nifty goes down by 1%, but the broader markets are down like on an index level 3%, on stock specific levels 8, 10, 15%. The breadth yesterday was maybe 95 to 1. Today it is even worse. And obviously, it's been a combination of a lot of things. It obviously started with valuations, growth being a little bit small, slower, and so on and so forth. However, it's got a little bit amplified due to news flow, which is coming, statements which are being made internationally related to tariffs and so on and so forth. Domestically, some statements have definitely caused some panic over the last 3-4 days. I think our view is that valuations were stretched. They have come off, quite a bit, but even now you don't have like hundreds of companies which you can go jump and buy. There is enough in terms of fair valuation, but it's not like completely cheap. Having said that, I think December numbers have been slightly better than September, and at least the indications for the current quarter, both on the economy side as well as corporate growth, seems to be, a little bit of reassuring. So in this kind of a scenario, as has been our experience in the past, it is best to just stay put, don't do anything, don't get swayed by short-term bounces and go overboard. Don't get scared by what is happening and sell at the wrong time. I think it is best to leave the markets on its own for the next maybe 6-7 days. Take a very measured and patient view and move forward. However, having said that, I think the indications which are coming from yesterday and today, and at least as far as my experience is concerned, of seeing these kind of markets, I'm starting to get a feeling that capitulation is very close, and this will, at least slow down or end pretty fast.
Okay. When Sunil Singhania says this, you got to listen. And Sunil, thank you for making that point. That's one key headline for me. I'm not going to take too much of your time, but I have 3 or 4 more pressing questions, Sunil, that I must ask you. One is the feeling, as you mentioned as well, globally some statements have been made. Yesterday we had Sridhar Shivaram here, who was saying that EM dedicated funds are seeing a lot of redemption. So it's not just India dedicated selling that is happening. And until that stems, FI outflows might well continue, and that might well continue putting pressure on markets, even if fundamentally markets reach valuations where there might be appetite to buy. Would that be a fair assessment? And what would your own thoughts be on this aspect?
So, last year was a tough year from a foreign inflow perspective. In fact, October was one of the worst months, where we had almost 1 lakh crore selling by FIs, and it was predominantly, buy China, sell India, largely because of the valuation differential, as also the fact that China had announced a major stimulus. I think things were normalizing to some extent in November and December. However, January started with a lot of statements being made in terms of tariffs and so on and so forth. The dollar index from 101 to, which was there in September, jumped to 110. Currencies all over the world sort of, started to move quite, aggressively. And I think Indian rupee was no exception. And I think that sort of spoofed the global investors, and it was risk off completely. So there was a movement back into US because currency was strengthening, and there was generally a risk off, as I said earlier. And that's reflected in the outflows from emerging market funds and India funds who had received quite a decent inflow over the last 3 4 years have started to witness outflows also because ultimately recency bias and recency performance does impact investors' behavior. Again, I don't know what will happen here, but this month has been very rough. On a daily basis, we are seeing almost $500 million of selling. But at some point, I think this has to stop. And I would say that we are nearing that sort of a phase. I don't know whether it will turn positive, but at least the intensity should slow down. The movement of rupee back to 86.9 yesterday and 86.7 today should be reassuring. And I think if global currencies stabilize, then there are more than enough funds who had missed India earlier who might use this opportunity and correction to build their positions. Because ultimately, there is no doubt that from a 5 7 years perspective, Indian economy continues to be one of the fastest growing economy, and I think Indian markets therefore should be one of the more interesting markets in the world.
Got it. Sunil, the fear has been around mid caps and small caps, as you alluded to as well, right? The Nifty is not giving the true picture, the broader markets are. Now, with the caveat, as you said, that let's leave the markets alone for the next 6 7 days, sit on the sidelines, wait and watch what happens. I'm inclined to ask this to you. A lot of high growth sectors, potentially high growth sectors, are not there in the Nifty 100. They might not be even there in the Nifty 150, if you will. Yeah, because there are a clutch of sectors that have gotten formed in the last 3 4 years. If valuations are attractive, but if the small cap space continues to see downticks, would you believe the good will get punished with the bad? Or after a 20% correction in the small cap index, the market will learn to differentiate between the two?
So again, a few things. One is the Nifty has not fallen because there are quite a few stocks in the Nifty, like Asian Paints, Hindustan Lever, Nestle, Reliance, maybe an HDFC Bank, an ICICI Bank, except maybe one like ICICI Bank. Almost all these companies have done nothing for the last 3 4 years in terms of price performance. And therefore, in this year, they did not fall also because they had not moved up. And therefore, the Nifty to that extent has been very resilient because 50-60% of the constituents who had not risen at all last 3 4 years have not fallen this 1 month. You can't say that Nifty has done very, very well. You have not invested for 1 month or 1.5 months.
True.
Having said that, I think you're right that there are quite a few stocks in the mid and small caps, which are new age companies, companies which don't have profitability or low profit, and which had a lot of hope built in. And the price went up 3 4x, and maybe all the IPOs which came in are a part of the mid or small cap indices, and they came at significantly higher valuations because of all the huge promises which were made during the IPO process, and they have also fallen. So in the mid and small cap, you will have to be more stock specific. For example, we invest only in profit making companies. So for us, these companies don't exist. But from an investor perspective, I don't think the indices are going to give you the best sort of conclusion. Because a small cap index might comprise of 300-400 companies. Some of them might not have profits at all, and therefore the P multiple also gets a little bit of it's not the fair estimation because the P looks like 30, but there are maybe 20-25% companies which are in losses, which sort of complicate the whole process. So mid and small cap is more about stock specific. Having said that, I would still advise, being a proponent of mid and small cap all my life, I would still advise at this point of time to have a balanced approach because this choppiness might continue for some time. We are looking at market stabilizing, but we don't see a V-shaped recovery. At best, it would be an upward moving W-shaped recovery.
Got it. Sunil, a lot of high growth pockets are being singled out in commentary, maybe on the markets as well, but in commentary. EMS has become the poster boy of making an example of how companies were overvalued. My question to you is this, that a lot of these companies are, even in the recently concluded quarter, giving some very high growth promises, right? And the managements are on record saying that we'll probably grow 40, 50, 60% or what have you. Now, my question, would these companies continue to get punished if they indeed show growth, EMS is one, the green energies exposed companies are others, or do you think the markets will start rewarding growth once the dust settles in the small cap space?
So Neeraj, markets obviously, respect fundamentals. But market price is equal to EPS into PE, and EPS is the profits, the PE is the perception. And perceptions change for a variety of reasons. New themes normally get a higher valuation because of the perception of higher growth and so on and so forth. So some of the themes and sectors you mentioned have great future, no doubt about it. At the same time, I think it's some of the companies which are listed got the advantage because there were not too many companies listed in that particular segment. So investors who are positive on that segment had very few choices, and therefore the listed companies got the benefit of scarcity. As we speak, more and more companies in all these high growth spaces are getting listed because equity markets have been kind. Businesses have been able to raise capital and grow quite rapidly, and that also creates, competition. But if the company keeps on growing at 50, 60% for 2, 3 years, and valuations have contracted at 40%, then at some point of time they will become very great buys because if you are able to get some companies which over a period of 5, 7 years can grow at 20% plus at maybe 25, 30 P, it makes tremendous sense. So market will take care of excesses as well as excesses on the downside. I think that has been the trend. No one is superior than the markets. Markets will normalize. From time to time, markets go into these phases of overvaluations, exuberance, and then low valuation, and then just panic. I don't think we have reached a scale of panic as far as valuation is concerned, but in terms of market mode and the intensity of the fall, we are somewhere closer. But markets will adjust on its own. And if these companies keep on growing at 40, 50%, then there is definitely going to be a lot of interest in these companies.
Sunil, I have one last question if you have the time, but just one last question, and that is on private markets, because they have become a very large part of almost every investor's book, right? Just trying to understand, they got a big fillip because of the kind of gains people made in public markets. I'm wondering if that space sees a significant cool off as well because of what's happening in the public markets, or could the template out there be different?
Neeraj, I would really, stick my neck out and say that market is going to give the maximum pain. Particularly what has happened over the last 1.5 years, there was so much capital available and there was such a huge FOMO. Any company with a presentation was able to paint great future and raise capital left, right, and center. And I think that went in a lot in private markets. We also launched a private market fund mid to late stage. Luckily, we follow a disciplined approach where we are value conscious and we don't invest in loss-making companies. And we had drawn down 20% of the corpus of 2,400 crores we raised, out of which we have invested around 75, 80%, but in good value companies. So we are quite, I think, sure that in the next 6, 8 months, we will get great opportunity. Because one, the propensity and the eagerness to invest in private market will go down significantly. A lot of investment, as I said, which has gone into private markets in the last 6 to 12 months, is going to give a lot of pain, particularly to large, high net worth individuals and family offices who had high risk appetite, and therefore the due diligence process shortened. I jokingly say that in bull markets, the time to research reduces and the bet size increases. And in bear markets, the time to research increases and the bet size reduces. So last year was a time when the time to research was 2 hours and the bet size was 50, 100 crores for each investor. The company used to come and say, "Bhai, dalna hai to dalo, nahi to isne dala hai, isne dala hai, aapko dalna hai to dalo." There was this FOMO. So I think over the next 6, 8 months, 12 months, that segment will again give opportunity. Right. But I would say that what money has been raised last 6, 12 months is going to give a lot of pain.
Got it. Yeah. Fair point. Maybe researchers or fund managers, it might be a good time because there will be enough time to choose and pick where you want to invest as opposed to it being running out.
So,
But
I'll just end, no
yeah, yeah,
one likes no one likes bear markets, and it is very painful. But I think in a cycle of markets, and we have seen that over the last 25, 30 years, sometimes these kind of pains come, and it's very easy to say that बेच देना चाहिए था, फिर ले लेते थे. That doesn't happen. And frankly, it is very tax efficient. So, say if our funds have gone down by 10, 12%, even if you would have sold and bought it back, that much money you would have lost in taxation.
taxation.
Yeah, and then entry point, exit point, impact cost, and so on and so forth. So these things happen. I think it is best to be a little bit patient. I know it is very tough, and particularly for people like us who manage public money. And I really, really, sympathize with the investors and RMs, and therefore we are doing a lot of calls also because this is a time to handhold and give fair advice. But please stay put. Don't try to do anything exotic. You might defer your investment. That is fine. But just don't sell because you're scared. You can adjust your asset allocation. If you're significantly overweight even now, maybe you can adjust a little bit. But don't get scared and do something which would amplify the already pain which we are all undergoing.
We started with the short-term advice from Sunil Singhania. Let the next 6-7 days go, be patient. And we're ending with a long-term advice from Sunil Singhania. Sunil, so important to have you on a day like this. Thanks for your time.
Thank you.